Hey everyone! If you're doing business in the UAE, I bet the new corporate tax is on your radar. Well, today, we're tackling a super important piece of that puzzle, depreciation. Let's get right into what you need to know.
So, think about all the stuff your business owns. That machinery, the vehicles, maybe even the building itself. A new tax law is here, and the big question is, how do you depreciate all of it correctly? Believe me, getting this right is a huge deal for your bottom line. All right, let's start with the basics. What are we even talking about when we say depreciation? In the simplest terms, it's a deduction you're allowed to take for the wear and tear on your major assets. You know, things like machinery, buildings, and vehicles. It's basically the government saying, hey, we get it, that expensive equipment doesn't last forever, so we'll let you account for that loss in value. Okay, so let's cut right to the chase. There's a lot of noise out there, a lot of what-ifs, but let's put all that aside for a second. The most important question is, what do you actually need to do today? And here it is, the answer you've been waiting for. For now, you can just keep doing what you're already doing. Seriously, whatever depreciation method you use for your accounting books, you can stick with it. That's a huge relief, right? No need to scramble and learn a whole new system overnight.
Now, this brings up a really important point. There's a difference between accounting depreciation, that's what's in your financial books, probably following standards like IFRS, and tax depreciation, which are specific rules from the tax authority. The key takeaway here is that while you can use your accounting method for now, the government has left the door open to introduce its own specific tax rules down the line. So this is a for now situation.
But, and this is a big but, don't think this is a free-for-all. The Federal Tax Authority, the FTA, can absolutely step in and challenge what you're doing if they think your methods are too aggressive or just don't make sense. So the bottom line is, whatever you do, you have to be able to justify it. Be reasonable.
So that leads to the next logical question, and I'm sure it's on your mind. Are there any fixed official tax depreciation rates from the government? Did they just give us a list and say, here, use these? And a short answer is, nope, not yet. The Minister of Finance can issue specific guidelines, but as of right now, they haven't. And that's exactly why the current rule is to just follow your existing reasonable accounting methods.
Okay, so the main rule is pretty simple, right? Stick to your books. But, of course, there are always exceptions. It doesn't apply to everything. Let's talk about a few assets that get special treatment.
So here are a few key ones to keep in mind. First up, land. You can't depreciate it, ever. It makes sense, right? It doesn't really wear out. Buildings, on the other hand, absolutely are depreciable. Then you've got things like vehicles, which might have some limits on how much you can deduct. And don't forget intangible assets like software licenses. Those can also be written off over time. That's usually called amortization, but it's a similar idea. This is another really important one to get right. Capital expenditures versus revenue expenses. Think of it this way. Buying a brand new, major piece of machinery, that's a capital expenditure. It's a long-term asset. You have to capitalize it on your books and then depreciate it over its life. But what about just fixing that machine? Routine repairs and maintenance? That's a revenue expense. And the great thing about those is you can usually deduct the entire cost in the same year.
Okay, that covers new stuff. But what about all the assets you already owned before this whole corporate tax thing started on June 1st, 2023? Good question. There's a special transition rule just for that.
And thankfully, it's a pretty straightforward three-step process. Step 1, just identify all those assets you had on your books before the new tax period kicked in. Step 2, figure out their net book value. That's just the original cost minus whatever depreciation you've already taken. And step 3, you just keep depreciating that remaining value from that point forward. The key thing here is you don't get a do-over. You don't get to start from scratch.
All right, let's talk about something super important with any new tax law, being audit ready. You have to assume the FTA might come knocking one day, so let's go over the documentation checklist you absolutely need to have.
So what does that mean for you? It's all about keeping good records. You absolutely need a proper asset register. You need to hold on to those invoices. And you need to be able to justify why you decided an asset has a useful life of, say, 5 years or 10 years. At the end of the day, what the FDA wants to see is consistency. They want to see that your story makes sense.
Okay, we've covered a ton of ground here, so let's boil it all down to the key takeaways. A quick summary to make sure we're all on the same page. So, here's the cheat sheet. Is depreciation allowed? Yes, absolutely.
Can you use your accounting books? Yes, for now. Are there fixed tax rates? Not yet. Can you depreciate land? Nope, never. And is documentation important? Yes, it's absolutely essential, non-negotiable.
And that really brings us to the final thought I want to leave you with. It's great. You know exactly what to do today. But remember, the law is written so that specific tax depreciation rates could be published in the future. So the real question isn't just about today. It's this. Your accounting books are ready for the for now rule, but is your business strategy ready for what happens when for now becomes back then?